navigating the risks of a potential SpaceX IPO. Wall Street is preparing for one of the most significant market events in recent years. The anticipated initial public offering, IPO, of SpaceX, with rumors suggesting a debut as early as June, excitement is reaching a fever pitch. Unlike many traditional IPOs, which are dominated by large institutions, SpaceX is expected to attract a massive wave of individual retail investors. While the prospect of owning a piece of Elon Musk's aerospace empire is alluring, the transition from a private powerhouse to a public company brings unique challenges. For those considering an entry point, three primary risks stand out. The retail rush and the secondary market trap. In a typical IPO, institutional investors, like hedge funds and pension funds, usually receive about 90% of the shares, leaving only 10% for the general public. However, SpaceX is expected to break this mold, potentially allocating as much as 30% to retail investors. This shift creates a specific structural risk. Financial experts warn that many individual investors may not actually be buying into the IPO at its initial offering price. Instead, they may be buying on the secondary market, the open exchange once trading begins. Retail investors clicking buy on the morning SpaceX opens are not early. They are the exit strategy for the venture capital and private equity shares, warns Chad Cummings, an attorney and CPA. Because retail interest can drive prices up rapidly at the opening bell, there is a high risk of a pump and dump dynamic. If the initial hype subsides, investors could face sudden, sharp price corrections. Experts suggest bracing for the possibility of a 10% or larger drop shortly after launch. Extreme valuation and long-term horizon. SpaceX's valuation is projected to be astronomical. Estimates suggest the company could be worth upwards of $1.75 trillion, with the IPO potentially seeking to raise $75 billion. This could push the share price above $600. The critical detail here is what is driving that price: future potential. Much of the valuation is built on the long-term promises of subsidiaries like Starlink, satellite internet, and XAI, artificial intelligence. The maturity gap. While institutional investors have the capital to hold a stock for a decade while it matures, individual retail investors often have different liquidity needs. Investing at such a high valuation means you are paying for tomorrow's success today. If the company fails to meet its aggressive growth milestones, the stock price may struggle to justify its premium. The Elon factor. Leadership-driven volatility. Perhaps the most unique risk is the inextricable link between the company's value and its CEO, Elon Musk. In the financial world, Musk is often viewed as the stock himself. This creates a level of idiosyncratic risk volatility caused by the actions of a single individual that most companies do not experience. This manifests in two ways: political and regulatory friction. Musk's public persona and political stances can impact SpaceX's most vital revenue streams. His interactions with government bodies can put FCC spectrum licenses and Pentagon contracts at risk. Market volatility. Much like the fluctuations seen with Tesla, a single tweet or a high-profile dispute with a lawmaker can trigger massive price swings. While volatility can offer high rewards, it also amplifies the downside, potentially moving the share price faster than an individual investor can react. Summary: while SpaceX represents a frontier-pushing opportunity in the space economy, investors must weigh the potential for massive growth against the risks of high entry prices. Extreme volatility driven by Elon Musk and the trap of buying into a retail frenzy.